Gold has been money, a war chest, a crisis hedge, and one of the most closely watched prices on Earth. But when traders say XAU/USD is moving, what are they actually looking at? XAU/USD is simply the price of 1 troy ounce of gold, quoted in US dollars. One number. And underneath it, interest rates, currency strength, inflation, and global fear, all priced in at once. XAU is gold's currency code. The X marks it as a commodity, the same way EUR marks the euro or JPY marks the yen. So XAU/USD isn't a stock ticker. It's an exchange rate gold, priced as if it were a currency of its own. It's the world's reserve currency, the common language most global prices get translated through. Priced in dollars first, then converted into whatever currency you actually spend. That's a structural fact of the current monetary system, not a comment on any single country's economy. So if XAU/USD reads 2,000, that means 1 troy ounce of gold costs 2,000 US dollars. Nothing more complicated than that. The number rises, gold got more expensive in dollars. It falls, gold got cheaper, or the dollar simply got stronger. So what actually moves that number? It's rarely one thing, it's usually 4. Priced in dollars, so when the dollar weakens against other currencies, gold usually costs more in dollar terms, even if nothing about gold changed. A weaker dollar buys less of almost everything priced in dollars. Gold is no exception. Second, what the Federal Reserve does with interest rates. Interest rates change how attractive it is to hold cash and bonds, instead of an asset that pays you nothing to hold it. Here's the concept that actually drives it: real yield. Take the interest rate. Subtract expected inflation. What's left is the real yield. Traders don't watch the interest rate on its own. They watch it against inflation expectations, because that gap is what actually matters to an asset like gold that pays no yield at all. When real yields are high, bonds beat gold easily. When real yields fall towards zero or below it, gold's zero yield stops being a disadvantage. That's the opportunity cost of holding gold, what you give up by not earning interest, rising and falling with real rates. Gold has a long reputation as a store of value when a currency's purchasing power looks likely to erode. Traders don't just react to today's inflation number. They react to where they expect inflation to go next. Fourth, fear. When markets get nervous, a banking scare, a war, a shock nobody priced in, investors often rotate into gold. Not because gold is exciting, because its value isn't tied to any single government's promise. That same logic applies to central banks. They've bought more than 1,000 tons of gold a year, 3 years running. That's more than double the average pace from the decade before it. Gold recently passed the euro to become the world's second largest reserve asset, behind only the US dollar itself. Here's what trips up a lot of beginners. Gold doesn't always do what the textbook says it should. Rates can rise and gold can still rise too. If inflation expectations are climbing even faster, or fear is doing more work than rates that week, gold isn't reacting to one input. It's pricing all 4 at once, and they don't always agree. Now, XAU/USD isn't just a price to understand. For some, it's also something to trade. That's where people get into trouble. In the US, federal law has restricted leveraged retail gold trading since 2010. These contracts must either deliver real metal within 28 days or trade on a regulated exchange. The CFTC has taken multi-million-dollar enforcement action against offshore platforms, offering exactly this kind of leveraged gold trading. That doesn't mean gold can't be traded responsibly. It means leverage on a volatile asset is exactly as risky as it sounds. Here's the honest distinction. Understanding why gold moves is not the same as predicting where it moves next. Professionals who study this for a living still get the short term wrong constantly. The mechanics are knowable. The next candle isn't. It's the dollar, interest rates, inflation, fear, and global demand compressed into a single number. 1 troy ounce, priced in dollars, moved by 4 forces most people never learn to see. Understanding those forces won't tell you tomorrow's price, but it's the difference between reacting to gold and actually understanding it. If you want to keep understanding markets instead of guessing at them, that's exactly what this channel is for.